Hi everybody, and welcome back to video number 6 in chapter 9. Okay, when we left off, we were looking at exchange that lacked commercial substance where cash was received. And just to review this, we had a total gain of 40,000 here, and we converted that gain as to defer the gain, we're going to take $4,000 here for the partial gain that we'll defer. And then down here, we show that $6,000. That's the difference between the 4,000 and the 10,000. And that's what we're going to show. So here, then, as we continue, the Publix records the transaction with the following entry. We're going to have the cash at $10,000. We have the gain on the disposal of the property here as a credit. The new machine we record at set $54,000. And then we have accumulated depreciation with a debit. And that will take that out, and the old machinery with 110,000. So if I go back, that's $4,000, and here's the 110,000 and the 50,000 and the book value of 60,000. Okay, so if we summarize the gains and loss recognition, number one, we're going to compute the total gain or loss on the transaction. This amount is equal to the difference between fair value of the asset given up and the book value of the asset given up. Now, number two, if a loss is computed in step one, we're always going to recognize the entire loss. But number three, if a gain is computed, then A for alpha, and the exchange has commercial substance, we're going to recognize the entire gain. But if it lacks commercial substance, as Bravo here, and one, no cash is involved, then no gain is recognized. If some cash is given, no gain is recognized. If some cash is received, the following portion of the gain is recognized. And here we talk about the cash received as boot, then boot plus the fair value of the other assets received times the total gain. Now, if the amount of cash exchanged is 25% or more, then both parties recognize the entire gain or loss. Fairly complex there. Okay, let's put it into practice with a valuation scenario from the Warbler Corporation. Number one, Warbler purchased a computer on December 31st for $105,000 and pays $30,000 down and agrees to pay the balance in 5 equal installments of $15,000 each December 31st, beginning 1 year later in 2025. An assumed interest rate of 10% is implicit in the purchase price. So Warblers negotiated the purchase of a new piece of automatic equipment on January 1, 2025 at a price of $8,000 plus trade-in, FOB factory. Okay, Warbler paid $8,000 cash and traded in used equipment. The used equipment had an original cost of $62,000, but it had a book value of $42,000 and a second-hand fair value of $47,800, as indicated by recent transactions involving similar equipment. Freight and installation charges for the new equipment required a cash payment of $1,100. Okay, they want you to prepare under Alpha here, prepare the journal entries for the computer, date of purchase, 2 at December 31, 2025, and record the payment interest using the effective interest method employed. And then 3, on December 31, 2026, record the payment and interest effective interest method employed. And then under Bravo, prepare the journal entry to record the new piece of automatic equipment, assuming that the exchange has commercial substance. And then Charlie, assuming the same facts as in Bravo, except the fair value information for the assets exchanged is not determinable. Prepare the journal entry to record this transaction. So let's do Alpha. Alpha here, we're going to record equipment of $86,861. And the way we get that is we take the present value of 15,000 ordinary annuity at 10% for 5 years. So we pick up this factor from the present value tables, multiply it times 15,000, and we get $56,861.85. We put down $30,000 already in present value, and that gives us the capitalized value of that new equipment. Now, the discount, then we're going to pay $30,000 in cash, and we're going to have a note payable for $75,000. We get that by taking the $105,000, subtract $30,000. So that difference represents an $18,138.15 discount. So a little complex there, but I think you can follow that arithmetic. Then on December 31st, 2025, we are going to reduce our accounts payable by $15,000. We're going to pay for that in cash. And then the interest schedule based on an effective interest schedule here is going to be 56.8619 based on 10% interest. So I think you can follow this arithmetic. We've done it several times before. Okay, so again, now for the journal entry for 2026, again, we'll reduce the notes payable by the remaining 15,000. We have the interest expense from this schedule here, right? And then the 15,000 in cash that we paid and the reduction of the discount on the notes payable. Okay. Now, if the exchange has commercial substance and no cash is received, then the full gain is going to be recognized. Here, the 56,900, we get that by taking the difference between 62,000 and 42,000, and then we will have accumulated depreciation of 20,000. We're going to reduce that. We're going to eliminate the 62,000, and our cash is going to be 8,000 plus 1,100 here, 9,100. Okay. So the valuation of this 56,900 is going to be the 8,000 cash, the installation cost of 1,100, plus the fair value of the used equipment, 47,800, and that gives me the cost of the new equipment. Okay. Here, the fair value information is not determinable. So the transaction is going to be recognized. We're going to have the 51,100. We get that by taking the book value of the old equipment plus the cash that we paid, 9,100, and that gives us the basis of the new equipment here at 51,100. Again, we get rid of the accumulated depreciation on the old equipment and the old equipment here for 62,000 and pay cash of 9,100. Okay. All right. Now we'll describe the accounting treatments for costs subsequent to acquisition. And here we have oil changes, repairs, replacing tires, replacing windshield wipers or windshields if they get cracked, that kind of thing. We're going to expense that when it's incurred. Yes, it does help maintain the car in working order, but just that. It maintains the normal working order. And we maintain a given level of service and do not increase the asset's future benefits. However, if we put in something that increases the useful life or significantly affects the operating efficiency of the car, like a new transmission, a new suspension system, a new battery for a hybrid car, that's a major expense, we'll capitalize that into the asset with a debit and depreciate that over the remaining useful life. We may have to adjust that useful life, but nevertheless, that's how we would depreciate it. So a capital expenditure is going to achieve greater future benefits for the asset, such as increased useful life, enhanced quality of output, or increased quantity of output. So, in general, costs incurred to achieve greater future benefits, we'll capitalize those. To maintain a level of service, we'll expense those. When we capitalize costs, one of the three conditions must be present. The useful life must be increased, the quantity of the units produced must be increased, or the quality of the units produced must be increased or enhanced. All right, so we have additions where we increase or extend the existing assets. We have improvements and replacements, which are a substitution of the improved asset for an existing one. We have rearrangement or reinstallation, movements of asset from one location to the other, and repairs, expenditures that maintain assets in condition for operation. Okay, so I think you have a pretty good feeling on how to do that. We're going to capitalize these costs. When we have a carrying value that's known, we'll remove the cost of the accumulated depreciation on the old asset, recognize any gain or loss, and then capitalize the cost of improvement or replacement. If the carrying value under Bravo here is unknown, if the asset's useful life is extended, we'll debit accumulated depreciation for the cost of the improvement or replacement. And if the quantity or quality of the productivity is increased, we'll capitalize the cost of the improvement replacement to the asset account. So I think that that's pretty clear. Let's take a look at an example for Lululemon here. They've decided to expand the size of its store to provide additional sales space for inventory. It contracts with an adjacent store to take some of the available space, but it will involve substantial remodeling costs of $200,000. As part of the remodeling costs, Lululemon will have to remove one wall and build a new wall in a different space at a cost of $35,000. The question then is, how would you account for these costs, assuming Lululemon anticipated expanding the size of the store? And here the solution is Lululemon should capitalize the remodeling costs of $200,000 as well as the $35,000 related to tearing down the old wall as it had anticipated expanding the size of the store. That looks like a good place for us to stop this video. And when we return, we'll take a look at a replacement substitution. Until that time, bye for now.